In a single trading session, the Sensex dropped 2,500 points, while the Bank Nifty collapsed by 1,800 points. Price action of this magnitude invalidates the standard thesis of a routine technical correction. When major indices gap down 2% at the open and finish 3% lower, we are observing a structural failure in the market. This collapse is the result of two distinct risk vectors arriving at the exact same moment. We have a macro geopolitical shock originating in the Middle East, running parallel to a micro corporate governance shock inside the domestic banking sector. These two isolated events collided in a single morning. The combined selling pressure wiped out weeks of established market structure in a matter of hours. Treating a 2,500-point drop across major indices as a standard buy-the-dip opportunity ignores the structural fractures forming underneath the broader market. Standard economic models dictate a predictable flow of capital during active geopolitical warfare. Institutional money flees equities and moves into safe havens, which typically causes the price of physical assets like gold to spike. This chart compares Nifty equities and global gold prices. Right now, gold is actively selling off alongside equities. On the monthly time frame, gold is forming a bearish engulfing Marubozu, a long candlestick with no shadows, indicating sellers controlled the price entirely. This simultaneous cross-asset liquidation overrides standard market mechanics and technical indicators. Physical safe havens are being dumped into the market instead of being accumulated. When traditional safe havens fail to hold a bid during a major military conflict, the market is signaling a systemic liquidity drain. Capital is being pulled from all asset classes to prioritize cash. The Middle East conflict has escalated past proxy skirmishes. We are now seeing direct drone and missile attacks on sovereign energy infrastructure. Specific targets have included Saudi Aramco facilities and Kuwaiti oil refineries. These attacks threaten the geographic chokeholds of the Red Sea and the Strait of Hormuz, which together control the majority of global oil distribution and European maritime trade. The immediate market reaction has been a sharp spike in crude oil, with prices rapidly approaching the $100 per barrel threshold. Rising crude costs place direct upward pressure on U.S. 10-year bond yields, which have already climbed to 4.27%. Surging U.S. yields, combined with expensive crude oil, act as a massive macroeconomic vacuum, forcefully draining liquidity out of emerging markets like India. Domestically, the banking sector absorbed its own shock with the sudden, unexpected resignation of the HDFC Bank chairman. The resignation explicitly cited ethical concerns that did not align with his personal values. Junior employees resign over workplace preferences frequently. However, when top-level executives abruptly exit citing ethics, institutional capital takes immediate notice. The market immediately suspected a specific structural issue: the systemic evergreening of loans to mask non-performing assets. Non-performing assets are loans that are in default, and evergreening is the practice of granting new loans to a borrower so they can pay off those old, failing debts. Evergreening artificially bloats a bank's balance sheet, making the institution appear stable while hiding financial instability under the surface. If the market suspects that an apex banking player is utilizing these tactics, institutions will immediately assume the contagion exists across the entire sector. This governance fear triggered a rapid institutional exit, forcing the Bank Nifty decisively below the 53,600 support level. This brings us back to the core anomaly. We have to ask why physical safe havens are being dumped into the open market while foreign oil refineries are actively burning. We have seen this specific market behavior before, notably during the 1979 Iran-Iraq War and the Islamic Revolution. In 1979, and again during the 2008 financial crash, gold experienced massive counterintuitive sell-offs exactly when fear was highest. This occurs due to the mechanics of a liquidity crunch. Highly leveraged institutions are forced to liquidate everything, including their safe havens, to cover immediate margin calls. A margin call occurs when a broker demands that an investor deposit additional cash into their account to cover steep, sudden losses. When margin calls hit en masse, standard asset correlations break down. Cash becomes the only acceptable asset. The current gold dump indicates the market is not pricing in standard war risk. It is pricing in a systemic evaporation of institutional cash. We can verify this macro liquidity drain by looking at the micro positioning within the Indian derivatives market. This chart shows the divergence in options open interest between foreign institutional smart money and retail traders. Open interest represents the total number of active, outstanding derivative contracts held by market participants. The data for foreign institutional investors and proprietary desks is decisive. They are aggressively shorting calls and going heavily long on puts. By contrast, the retail client data is overwhelmingly bullish. Retail traders are attempting to catch the falling knife. Many point to the put-call ratio currently sitting around 0.7 as a sign of an oversold market. The put-call ratio divides traded put options by call options to gauge sentiment. However, this metric becomes highly unreliable during periods of massive range expansion and extreme volatility. There is currently a massive wall of put options concentrated specifically at the 23,000 level. That strike price is now a critical algorithmic battleground. By aggressively buying the dip, retail traders are unknowingly providing the exact exit liquidity needed by foreign institutions who are actively bracing for further downside. Bringing the macro liquidity drain and the domestic banking fears together, we arrive at the physical price action on the stock chart. This chart identifies the primary support floor for the Nifty index. Price rests on a horizontal zone between 22,800 and 22,900. The structural case is strictly binary. If 22,800 breaks decisively on a daily close, the technical floor falls out. The freefall trajectory points directly down to the next macro support zone at 21,800 to 21,900. Holding unhedged long positions or failing to trail stop losses inside this volatility zone is statistically dangerous. If this multi-tested support gives way, algorithmic stop-loss hunting and aggressive short selling accelerates downward momentum. There is one bullish counter-narrative to consider: the potential for a heavily engineered relief rally. The domestic market is preparing for massive liquidity events, specifically upcoming IPOs for GEO and NSE. Institutions and market makers may attempt to artificially prop up the index toward 24,500, ensuring favorable listing conditions for these new entries. This creates a fragile tension. Any artificial technical support will have to hold the line against the severe fundamental and macroeconomic headwinds actively draining cash from the system. Do not trust blind buying in this environment. Manage your risk aggressively. If you hold existing shorts, book partial profits to cover your cost basis. Wait for the liquidity paradox to resolve before committing new capital.